Hi all, my name is Paula and I'm part of the distribution team at Ashburton, looking after independent financial advisors. Today I'm joined by the better known Albert Botha, Head of Fixed Income. Hi Albert.
Hey Paula, how are you?
Very well, thanks. Albert and his fixed income team run a wide range of funds for us, from our Ashburton Money Market and Core Plus Income Fund, all the way through to our Ashburton Targeted Return Fund, which is our multi-asset low equity fund. So today we are going to just unpack what happened in the fixed income space over the last quarter, and then I'm going to pose some questions to Albert, more on the portfolio construction side, opportunities, threats, and just questions that we get from our advisors. So Albert, fixed income assets, they had a wonderful second quarter with the All Bond Index returning close to 8%. Can you unpack what happened in the last quarter and if you see these returns as being sustainable?
The second quarter, I think, is important to think about what the starting point was, right? That's one of the big problems we sometimes see when people look at asset class performances, fund performances, is they forget that there's a leading edge and a trailing edge. And as you move through time, these things do that. So the second quarter of 2026 had absolutely astounding performance because March was a war, right? So we saw a massive sell-off from the end of February to the end of March. So the returns you got for that quarter is at least partially mirage. You have to look at the period spanning the war, right? So a 6-month number rather than just a 3-month. Because your 3-month number January to March is going to look terrible and your 3-month number March to June is going to look great. Yeah. So you kind of have to try and strip that out. So to answer your question, no, it's not sustainable, right? The starting point was very low. Yeah. And the consequences of the conflict changed what the world looks like. We went from thinking that interest rates can be cut to interest rates are rising. We were thinking from this, not quite the Goldilocks scenario, pretty close to it globally, to significant uncertainty, a rolling war, a stop-start war, uncertainty about when it starts. We just saw recently as well that the Houthis announced that they're not going to be blocking Saudi Arabia, which is another issue because that's not the Strait of Hormuz, that's on the other side. So there's a lot of moving pieces up in the end and significant increased kind of uncertainty and volatility.
Okay. All right. So, I mean, you mentioned the war, and I think it's obviously front of mind for clients and advisors alike. And you recently argued that higher oil prices does not necessarily lead to long-lasting inflation.
Yes.
So what is it that advisors need to look out for to determine whether inflation is a long-term strategic threat rather than just short-term headline risk?
Some of the best things to look at are kind of market variables, market indications. People talk about break-even inflation rates. But for example, both the Reserve Bank in South Africa as well as internationally, they publish inflation expectation indices. And inflation expectation in the US has continued to fall off over the last couple of months. It's meaningfully lower than at the start of the war. People are expecting inflation in the US, for example, to be below 2% as we go into next year. Middle of next year. In South Africa, the inflation expectation is effectively likely to be somewhere around 3%, at least for June, July 2027. So the kinds of forecasts that you get from economists, not for the next sprint, but for the one kind of a year or two ahead. And then if you like a little bit more dense reading, the Reserve Bank publishes longer term inflation expectation forecasts as well. Those are the kind of things that you need to keep an eye on. Because historically, in cases like this, what happens is, and I'll go through it a little bit, is that the oil price spikes and then the world starts to adjust, right? Slowly but surely, right? America pumps more oil, Venezuela pumps more oil, so the other countries pump more oil. People find alternatives for high oil prices, etc. So normally, what happens is that it starts falling off. We're not quite there yet. There is still the risk. A number of countries, including the US and China, are still depleting their reserves. As of shooting this, there's about 40 days of reserves left for the US. So the risks for a catastrophic oil price is still in the system, but it's not something that we have to worry about in the next couple of days or the next 2 or 3 weeks. It's a month, 2 months down the pipeline if nothing happens and if the war continues to escalate. Okay,
so there still is a concern.
There is still a concern. There's still a tail risk, right? Yeah. But the reality is that there's a tail risk towards both ways. That's almost always true.
Yeah.
We tend to focus on specifically the fixed income people tend to focus on the tail risks of what can go wrong, but a lot of things can go right, and we can have inflation in South Africa at sub 3%, kind of 2.7, 2.8 by July next year. So it can go both ways quite easily.
Okay, cool. Well, thank you for setting the scene in terms of where we are in the market. To get more into the sort of portfolio construction questions, we're finding that a lot of clients are still very heavily invested in cash, having benefited from, enhanced money market yields. When does staying in cash become a greater risk than moving into longer dated fixed income assets? In essence, how do we get clients to move up the risk curve, and is it the right time to move up the risk curve?
I think there are a number of different sets of clients, right? Because when we run money for people in your space, in the IFA and private client space, and generally those people have multi-decade kind of outlooks. They don't always think about it, they don't always realize it. But if you think about even someone age 60 has probably a 20-year investment horizon, right? And for those types of clients, sitting heavy cash is almost never really the right answer. I understand that there are circumstances. I just sold my house. I need to buy something else.
Yeah.
I just sold my business. I'm going to move my money offshore. I've got to pay for studies for kids, etc., etc. But for personal financial provision, pension, investment-linked life annuities, all of those kinds of things, being very, very cash heavy is almost never really the right solution.
Yeah.
We also manage cash for pension funds. We also manage cash for corporations, and they have a meaningfully different set of circumstances. Pension funds have to provide income to a wide group of people. They now have to solve for two pots, right? All of those things start meaning that they probably have to sit on quite a bit of cash.
Yeah.
Corporations have to sit on a lot of cash for a variety of other reasons. So it depends on what your circumstances are. We started this year thinking that there's going to be a massive rush of clients moving from kind of your cash mandates to your higher risk mandates, primarily because we were in an environment where cash yields and think about your repo rates and were falling.
Down,
and we were expecting a number of rate cuts both here and overseas. And that would have meant that clients are looking for higher yields. The reversal, the rate hike here, the expectation for probably another rate hike has reversed that trend a little bit. But structurally in South Africa, the rate picture is still kind of lower.
Yes.
So we've delayed the impetus, but we probably haven't stopped it. So I think to circle all the way back to your clients, the biggest conversation I had, and I think I had it with you at the start of the year as well, is that when we think about savings, we talk about savings. We speak about it in a real terms. So we'll say things like, I get inflation plus 4. We're aiming for inflation plus 5. Clients in equities get inflation plus 6. But there is a meaningful segment of the South African market that don't live in those real terms. They live in nominal terms.
Yeah.
They have an amount of money. They're invested quite conservatively, and they are withdrawing a certain percentage of that every month to live from. Right? They live off the interest. And for that subset of clients, this reduction in rates and that reduction in inflation and expected reduction in rates is going to mean that their nominal income is going to be less, depending on where rates end off anywhere from 15 to 25% less than they would have been used to. And that subset of clients is going to have to move up the curve. They're not going to have any other option. And for most of them, you probably want to move before you are forced to move. Right, so you probably want to be in a position where you move from cash to slightly high yielding assets before the cash gets to those low yielding assets, because low yielding rates, because that would have meant the entire curve has shifted down. So maybe not today, maybe not tomorrow, but probably somewhere between now and the end of the year is something you want to think about.
And I guess what's nice about the Ashburton fund range, your fund range, is that there's such a wide range of funds that you can tier it up one by one. You don't necessarily need to go from cash straight into a multi-asset low equity fund. Just with regards to your team at the moment and where they're seeing opportunities in the markets, cash, bonds, credit, other asset classes, and in the same breath then, what is it that you guys are avoiding in your portfolio construction at the moment?
So one of the easiest things to say that you're avoiding at the moment is probably global credit, right? Global credit is trading at specifically investment grade credit, and to a slightly lesser extent high yield, but specifically a lot of your global credit is trading at multi-decade lows, right? They're trading, if you look at, if I may be technical for just a second,
yes.
They're trading at the 0th percentile. So we look at where these credit spreads have traded for the last 20 years. We look at that history, and it's trading at the bottom of what we've seen in 20 years. So credit spreads globally are very low. So you're not being rewarded meaningfully for taking credit risk.
Okay.
This is happening at the same time where a number of large multinationals, hyperscalers, a lot of those kind of guys are issuing more debt than they have in years because they need to build out data center capacity, etc. So we're not looking at that. In the global space, we are looking at, for example, just simple straight government bonds, not very long, because there are funding issues in almost most governments. But buying, for example, a 2 or a 3 year US government bond, you can buy it, you can hold it, and you can wait it out. You're going to get the return on your investment because that's what yield to maturity means. Occasionally, there are some other opportunities. US stocks, as well as they've done, seem very expensive at the moment. It's all, but it's difficult to move away from because it's such a large portion of the global market. If you buy, for example, MSCI World, something like 65% plus of that is US stocks anyway. Yeah. So to diversify away from the US is kind of challenging. And if you think about what else is around the world, the European Union has its issues, China has its issues, Japan has its issues, the UK has issues. So kind of where do you go to? There are some regions that's starting to look better. South America is showing some promise, but it's very difficult for a South African investor to go and say, I am going to buy Argentinian and Colombian and Venezuelan stocks, right? That's not really something that you can do as easily. Even us in the portfolio context would struggle to do something like that. It's harder, and in the fixed income space, we don't touch those things at all. Some of the emerging market debt looks a little bit interesting as well. And in South Africa, inflation-linked bonds and government bonds are looking decent, not as attractive as they did, say, 2 years ago when we were getting yields of real yields of 7%. South African inflation-linked bonds are yielding 4% above inflation. And the nominal bonds are anywhere between 4.5% to 5%. And kind of in a long-term outlook, getting 4 to 5% above inflation on a government guaranteed asset is attractive. Yeah. There is going to be some volatility between now and the end, whenever you pull your money out. But because of the uncertainty around the war, there's South African local elections that's coming up, all of those things. But the SA asset classes are looking, specifically on the fixed income side, are looking decently valued. Properties had a very nice run. We were in March and April, we bought some property for some of the funds. That's done very well. Whenever I talk to our equity manager, he's very, very excited about some of the equity sectors in SA. Our equity index in South Africa hasn't really recovered. What I mean from that is that we are still trading at pretty close to the lows that we saw at the bottom of the crisis. So our stocks market hasn't recovered. So there's some opportunities there. And then the SA credit market is very tight, right? So there's not a lot of credit being issued. The converse of what you said about a lot of people sitting in cash, it means that there's a lot of cash available, which means there's a lot of people looking for credit with a very small credit availability. So credit spreads in SA are quite low. So that's a little bit less attractive than I'd like. Meaningfully underweight global credit. We've got some global US bonds, dollar bonds, specifically US government, more towards the short end.
Okay.
That's kind of where we're sitting. And then with the Rand, whenever the Rand gets close to 16 Rand to the dollar, especially now, it seems like it's an asset you can buy. What to do with the money once it's offshore is a separate question. Luckily, there are things that you can do. You can buy the currency without having to buy offshore assets, or you can buy offshore assets without having to buy the currency. Those two decisions don't have to be linked.
Yeah. Okay. So, I mean, you went into quite a lot of detail on the global assets as well there. And a question that you might not feel that comfortable answering, but over the last several years, we have seen a lot of advisors take significantly more of their clients' money offshore. Given that you're finding South African fixed income or the enhanced yield here quite attractive, do you think that SA fixed income deserves a bigger strategic weighting in clients' portfolios?
Client portfolio planning is a individual version of what in the industry they call LDI or liability-driven investment, or ALM, asset liability matching. And it varies meaningfully from client to client, right? If you have a 25-year-old or a 30-year-old that you're managing money for, or that's going to earn a lot, his asset allocation is going to look very, very different from the 75-year-old or 80-year-old grandmother, right? For the 75 or 80-year-old grandmother, having a very high exposure to SA fixed income is probably something that you should think about. From a strategy perspective, I think the longer your time horizon tends to be, the younger you are, the bigger something like country risk and home country bias starts becoming, right? In the sense that if you think about 15, 20 years ago, everyone was saying, you know what, China it's the next global leader, right? At the moment, it doesn't seem that way. 20 years ago, South Africans were immigrating to the UK in droves because that's where all the career options was. At the moment, people are moving back. The betting a meaningful amount of money on a country, any country, whether that country is South Africa or the US, long-term isn't a prudent investment. I think as South Africans, we are fortunate that we have the option that our conservative portion of our portfolio in rands gives you very, very high returns. Yeah. That's not something a lot of other countries see. So you don't have to go anywhere else in the world for your fixed income allocation. Right? Fixed income allocations are shorter term by nature, they're more conservative. And in SA, you're going to get some of the best risk adjusted returns at very, very high liquidities of anywhere you can in the world. The moment you start looking for kind of your growth assets, having a mix of SA assets and global assets start making sense. But outside of the very, very wealthy, which includes founders of banks and those kinds of people, having meaningful kind of dollar fixed income allocations doesn't really make sense on an individual level. It makes sense in a portfolio level, like some of the things we run. So for most clients, your SA fixed income is probably going to serve you very well.
Albert, what do you see as the biggest portfolio positioning mistake that an advisor can make over the next 12 months?
The biggest kind of mistakes people tend to make, right, are the kinds of things where they've seen their neighbor or anyone else making meaningful amounts of money in Bitcoin or gold or Nvidia, right? And they go, okay, you know what? I've sat this out long enough. I'm getting in. Yeah. Right? That's almost never a good idea, specifically when it comes to things like single stocks or when it comes to things like very, very niche ETFs, right? So a silver ETF or a gold ETF. I'm not saying that those are bad things to use. I'm saying that when you buy them out of fear or missing out, or any of those things, that's generally the thing. The biggest, let's say, counter emotion in investments is FOMO, right? When you start feeling FOMO, you should kind of know this is an asset class you want to stay away from. January and February this year, I got a number of calls from clients directly asking if they can invest in the bond fund. Because the bond fund had down almost 30% year on year, right? And I had to try and explain, but this is not, I understand that this is my fund, but you're seeing 30, the current yields are 8. Yeah. That means the fund's going to do 8 to 9 max over the next 12 months. If you understand that, you're happy with it, but you're not going to get 30 again. Yes. Chasing performance is generally not something that you should do either from managers or from asset classes.
Yeah. Okay. So Albert, final question. There is a lot of noise in the market at the moment, as we've discussed. What is the one guiding principle that you and your fixed income team follow when investing on behalf of Ashburton clients?
Within the fixed income space, and Ashburton is very much driven by valuation, whether it's the credit business, which is both listed and private credit. The equity portfolio managers are very much valuation focused as well. In the fixed income space, there's a very strong valuation tilt as well. The reason we talk macro so much is because so frequently questions around valuation in fixed income touch on broader macro principles and broader macro concerns in a way that other asset classes maybe don't. I think within the fixed income space, our primary concern is trying to identify the relevant risk for a portfolio and then allocating assets and securities in a way that best takes advantage of spending that risk, right? Any portfolio runs on the principle of spending a risk budget to gain returns, or at least expected returns. And we focus very, very much on that effectively, right? At the moment, the way we're thinking about it is that we're not gaining meaningfully from participating in kind of, for example, as I said, global credit. So we are effectively just trying to sit on the sidelines in for example, US government bonds, shorter term US government bonds. In the SA market, we are not gaining by meaningfully looking at a lot of the listed credit out there. So we have a little bit of less listed credit. We are looking at unlisted credit, and Ashburton, as everyone knows, has a pretty strong unlisted credit capability that we can lean into when those things and those deals become available. We try and take advantage of some of those as well. But I think at least for the moment, the big thing that it for a lot of people is that now is not the time to try and really chase returns. It's not that, to use a cricket metaphor, even though I never played cricket and I don't watch it that much, is kind of you're an hour away from the end of the day, right? You're not trying to hit sixes. Tomorrow's another day. Yeah. You're pushing for ones and twos. Okay. And the nice thing about fixed income is if you push enough ones and twos, you'll get there as well.
Albert, thank you very much for your insights and input. The financial advisors always appreciate what you have to say. We hope you enjoyed the session with Albert today, and we look forward to seeing you in our next session.